Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. Real quick, do us a favor, go to iTunes, search Tusk Media LLC and hit subscribe. We really appreciate you doing that. All our stuff is available in audio format. You can even go back and listen to some random topical stuff. I think we talked to Ben right when he started working here about a year ago about his life, so you can go listen to that. We've done talks on bonds, all kinds of interesting stuff. So go back, check out all that stuff. It's in the archive. If you like it, leave us a 5-star review on iTunes. Helps us get found. Also check us out on YouTube, youtube.com/TuskMediaLLC, Facebook.com/TuskMediaLLC, Twitter.com/TuskMediaLLC. Let's get going. Andrew Hall here, Ben Nye. How you doing?
I'm doing well. It's nice that we have the whole tropical mass has kind of left, and now we have the sun.
We got the sun and pretty cool temperatures here in Atlanta. Yesterday was awesome. It was deceptively sunny. I got super sunburned, but
yeah, me too.
I'm always kind of due for one of those a year, and it was nice to do it when it was high 70s.
Had a nice
80s.
breeze too.
Yeah, felt really good. I actually did some work outside yesterday, like work, not like yard work. Yeah, it's weird. Took my laptop outside. Kind of fun. Anyways, we're here today. We're going to talk about FedEx. Earnings came in last week, so ticker FDX. Full disclosure, we do own some FedEx in portfolios. It's a stock that Ben, in particular, is kind of championed here in the office. So Ben, kind of high points of the quarter, the big numbers. What were the headlines that everybody was talking about?
Yeah, so kind of taking a step back, last quarter FedEx had what people perceived as a fairly disappointing weak quarter, but the guidance was pretty solid. This quarter was a little bit the opposite. The quarter was very good, beat on all metrics. The guidance was a little weaker than I would have liked. Specifically, I was disappointed in the margin in the ground business. In the ground segment, that's kind of the competition with the United States Postal Service. I was disappointed in the EPS guidance for the next fiscal year because this was the conclusion of fiscal 17. And I was also disappointed in the CapEx forecast, which was higher than I would have liked. On the other hand, I'm seeing some good things out of Europe with the FedEx Express business. Some good things from that trade side of things where FedEx is big. And TNT Europe those synergies continue to be guided toward. They're not taking that guidance down. So that's a positive as well. Looking forward, I want to see the margin picture improve a little bit. That's going to be a huge key so that we can get some upside beats to consensus estimates in this next fiscal year.
So it sounds like, kind of from your perspective, almost the second quarter in a row that was good, maybe not great because of a combination of both, the actual data that came in as well as guidance.
Right.
And a little bit of, kind of conflict there, but then again for different reasons than a quarter ago. What, you mentioned margin expansion and kind of looking for that. You also mentioned, FedEx Express over in Europe. Talk to me a little bit more about what you're specifically looking for and hoping for on those avenues.
So what happened was the FedEx ground business has been in a downtrend in terms of margin for at least the last 2 years in terms of their operating margin. And that's disappointing because it's a large portion of the revenue and it's an even larger portion of the operating income. It's the highest margin segment. So when you have operating margin declines from about 18% to about 14% on a trailing 12-month basis, that's not what you want to see from your biggest segment. That said, we did hit 15% last quarter. The quarter before that was pressured from a variety of things, but primarily a lot of their e-commerce customers said to build capacity that didn't end up being filled. So FedEx was left on the hook for a lot of this spare unutilized capacity because it wasn't actually being employed. And those incremental margins on FedEx are so large that if you have a little bit better revenue, a lot of that's going to drop to the bottom line. And that's what happened this quarter. You had a little bit better revenue, so a lot of that dropped to the bottom line. Ground margins, though, still, even though the revenue was better, only hit 15%. I was looking for more than 15%. That's what management guided to last quarter, and they only hit 15%. So looking forward, I want to see more out of that. I want to see some stabilization in the ground margin on a trailing basis. And specifically, I want to see what they're going to do with price increases going in the back half of the year. UPS just announced their intention to raise prices for the Christmas selling season and that transport market. It'll be interesting to see if FedEx follows. Mm-hmm. It's an intensely competitive industry, but it is dominated by 2 or 3 large players. And in domestically, you have DHL, you have UPS, you have FedEx, and you have the United States Postal Service. So they all work together, but they're all competitors as well.
Mm-hmm. So thinking specifically, when we looked at this, we viewed it in a lot of ways as kind of a macroeconomic play,
right?
Kind of a play on the economy more broadly, specifically kind of on the B2B side. Do you remain optimistic on that beyond things just like a little bit of pricing control and kind of that oligopoly that you have there? Do you remain optimistic of, I guess, the broader secular trend?
Yeah, and I think that's kind of how you have to look at FedEx, because there are some things they can do operationally. They can have really solid systems in terms of the logistics business operations, but at the end of the day, they're going to perform based on how that side of the economy does, the B2B side of the economy. And right now, they're looking for 2.2 to 2.5% GDP growth. They do better if we can have GDP growth that's better than that. FedEx revenue will be higher, should be higher, and a lot of that is going to drop to the bottom line because they do have those solid incremental margins. If that GDP growth falls below 2, it's 1.5, 1.2, you're going to see some pressure on FedEx. Mm-hmm. And that's kind of what will dictate the stock price. So as an industrial, as a transportation company that's levered to the B2B side, I like FedEx, but it's enveloped in that view that the economy is going to grow faster or as fast as 2.5%. Mm-hmm.
Which again, not everybody would know this, but I think you're relatively bullish on the economy. There's still good data coming through, so it makes good sense that your conviction with the stock is
right.
Where it is, just given that and given the expectation for growth.
And it's different from a lot of industrial companies. You can't compare it apples to apples with something like GE or Honeywell or United Technologies. But it's kind of still in that same, transport is an industrial. And so as far as industrials are concerned, this has a relatively low valuation for that space. The thing you got to watch out for is the cash flow. They just continue to spend on that CapEx, which really diminishes their free cash flow, which is why the dividend yield is so much lower than a lot of those other companies I mentioned. And I was disappointed with that CapEx going into next year. I want to see that come down. Hopefully, they'll get enough planes in their fleet, and they'll be able to actually, leverage some of that CapEx going into the future. But right now, want to see some control on that CapEx side. Want to see some free cash flow, so that money is actually getting returned to shareholders.
Mm-hmm. And that's really probably the theme as we kind of continue to watch this.
Yeah.
In some regard, again, growing economy means success for this company. Slow growth could be a challenge, but then you still have to pay attention to kind of the operational side of the side of the story here. Most likely continuing to hold it, I would think, for most accounts.
Yeah, I'm continuing to hold it. Around 225, around 230. I might start to look at some calls and selling those, but right now I'm a holder. I'm not a buyer though at 215.
There you go. Anything else on FedEx?
That's it for me.
All right, this is the Investing Podcast. Thanks for being here. We will be back. Lots of content coming as we kind of swing back into earnings season. So thanks for being here. We'll talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.